So normally when you look at a company's financial growth, there is this very basic, um, almost mathematical logic at play, right?
Like the whole if you sell more things, you make more money concept.
Exactly. It's the foundational rule of business. But today we are looking at this just staggering financial paradox.
Oh, it really is a paradox.
Yeah, like how does a company grow its revenue by 185% in a single year? Which, sounds incredible on the surface, yet at the exact same time possess a net margin of negative 2,253%.
It breaks the brain a little bit to look at a balance sheet like that, to be honest.
That totally does.
We're so accustomed to the top line and the bottom line telling a cohesive story.
Right.
And here, they just seem to exist in two entirely different universes.
Yeah, completely disconnected.
Right. I mean, you have triple-digit growth on one side and then this absolute black hole of capital on the other.
Well, welcome to the deep dive. We are sorting through a massive stack of financial reports, SEC filings, and market sentiment data today.
A lot of paperwork for this one.
A ton. And it's all centered on Rigetti Computing. They're a really prominent player in the quantum computing space.
Very prominent, yeah.
So the mission here is to help you, the listener, figure out whether this high-tech moonshot is, a visionary long-term play, or if it's simply a cash-burning trap that's going to leave investors empty-handed.
Which is the million-dollar question. Or I guess the multi-million-dollar question.
Seriously. And we are pulling this from their Q2 2026 earnings data, some technical market feeds from mid-August 2026, and the latest analyst research.
So to really grasp the gravity of those numbers you mentioned, you kind of have to understand the sandbox they're playing in.
Right, the quantum sandbox.
Exactly. Quantum computing is arguably the most notoriously expensive, highly competitive frontier in modern tech right now.
It's not just building an app.
No, not at all. You are dealing with physics at subatomic levels. We are talking about supercooling equipment that brings temperatures down to near absolute zero. Yeah, incredibly specialized materials and literally years of theoretical R&D before you even have a prototype, let alone a commercial product.
So the capital expenditures are massive by design.
By design, yes. Rigetti is currently sitting at this brutal tipping point right now between being a very expensive science project and an actual commercially viable business.
Let's look at what that tipping point actually looks like on paper then. In the second quarter of 2026, Rigetti's revenue jumped to roughly $5.1 million.
Right.
Which is a 183 to 185% year-over-year increase. If you just saw that headline in a press release, you'd assume they were taking over the market.
You really would.
Yeah.
But the headline is incredibly deceptive.
It usually is.
Yeah. We have to contextualize that $5.1 million. Because while revenue is up, the company remains deeply, structurally unprofitable.
Very unprofitable.
Just for that April to June 2026 period, they reported a net loss of $52.6 million.
Okay, wait. They made $5 million and lost $52 million in a 3-month window.
Yes, in just 3 months. Their adjusted earnings per share, or EPS, was negative 5 cents.
Which doesn't sound terrible on its own.
Right, and it actually matched analyst estimates. It even represents about a 61% improvement from the prior year.
Okay.
But matching expectations for a colossal loss is still, practically speaking, a colossal loss.
Yeah, you're still losing massive amounts of money.
Exactly. The extreme gap between that tiny revenue base and those giant operating losses is what generates that absurd negative 2,253% margin number.
I was actually trying to wrap my head around a negative 2,200% margin earlier, and I came up with an analogy.
Let's hear it.
Okay, it's like opening a pizza shop where you manage to sell a slice of pizza for $1.
Okay.
You're high-fiving your staff because, hey, sales are up 185% from last year when you barely sold anything.
Right, huge growth.
But then you look at your receipts and you realize that between the imported Italian flour, the artisan cheese, and the massive electric bill for the oven, you are spending $23 just to bake that single $1 slice.
That is a terrible business model.
Right. Every time you ring the register, you are bleeding cash.
The math in your pizza analogy is spot on.
Okay.
But it actually fails to capture the underlying economics of what Rigetti's building.
Oh, really? How so?
Because baking a pizza doesn't scale the way deep tech scales.
Okay, fair point.
If you invent the world's first truly commercially dominant quantum computer, you don't just sell one slice at a time.
You sell the whole pie.
You instantly hold the monopoly on revolutionizing things like drug discovery, optimizing global logistics, and, breaking modern encryption.
Which is massive.
Right. So the market isn't paying for pizza ingredients here. They are paying for a lottery ticket on the future of computing.
Well, that lottery ticket mentality actually explains a metric that completely jumped out at me in the sources.
The PS ratio.
Yes. The trailing 12-month price-to-sales ratio is sitting at roughly 620.
Which is wild.
Just for anyone not staring at stock charts all day, an average healthy company might trade at a price-to-sales ratio of like 2, or maybe 5 or 10 for a fast-growing tech stock.
Sure.
620 is astronomical.
It means investors are paying $620 for every single dollar of sales the company currently generates.
Wow.
But this raises a crucial point about how markets value deep tech.
Because they're valuing the future, right?
Exactly. The market is pricing in that future potential we just talked about, completely ignoring current efficiency.
They don't care about the pizza ingredients.
No, they're turning a blind eye to the $52 million quarterly loss, assuming that one day Rigetti will figure out how to make 1 million units for pennies.
Looking at their balance sheet, my first instinct as an investor is actually to celebrate one specific detail.
What's that?
As of late 2024, they reported 0 debt.
Ah, yes.
No debt means no bank can just force them into bankruptcy tomorrow. So, am I wrong to view that as a massive safety net?
I mean, that is a dangerous assumption to make when the corporate wallet is effectively on fire.
Okay, fair.
Having 0 debt means you don't have mandatory interest payments, which is a positive, sure. But if you have no cash and you have no debt, how do you pay the $52 million a quarter it takes to keep the lights on?
Right. You still have bills.
Exactly. Let's break down the ticking clock on their balance sheet. As of June 30th, 2026, their cash and cash equivalents dropped to just $27.7 million.
27.7. And that is down from 44.8 million at the end of 2025.
Yes. And in just the first half of 2026, their operating cash use was about $32 million.
Just on operations.
Right. Plus another $16.4 million in capital expenditures.
So if you are burning cash at that rate and you only have 27 million left in the bank,
the runway is incredibly short.
It is a matter of months.
Literally months. And because they aren't borrowing money from banks, they have to get that cash by issuing more stock.
Right.
Which introduces the concept of severe dilution risk.
Break down the actual mechanics of that for a second, because dilution sounds like this harmless corporate buzzword, but it actively destroys value for the everyday investor holding the stock.
It definitely does. Think of the company's total value as a whole pie.
Back to the pie. I love it.
Right. If you own a share, you own a specific tiny slice of that pie. When a company needs cash but can't or won't borrow money, they create new slices of the pie out of thin air and sell them to the public.
Okay.
The company gets the cash it needs to survive another quarter, but your original slice just got physically smaller.
Because there are more total slices now.
Exactly. Your ownership percentage is diluted, and the sources clearly highlight that for Rigetti to survive, they will have to rely heavily on these equity raises.
And the more they do that, the more they risk entering what the market calls a dilution doom loop, right?
Precisely. And the mechanics of a doom loop are vicious.
It sounds vicious.
It is. Because if the stock drops, since investors are scared of the cash burn, Rigetti has to issue even more shares to raise the exact same amount of cash.
Because each share is worth less.
Exactly. And flooding the market with all those new shares drives the stock price down even further.
Wow, okay.
Which means the next time they need cash, they have to issue even more shares.
Yeah.
It becomes this downward spiral that just wipes out early shareholders.
What really underscores that danger is what the insiders are doing.
Oh, yeah.
The data shows that the executives and the people closest to the technology have sold over 1 million shares on the open market recently.
Over 1 million.
1,039,341 shares sold, to be exact. And the number of open market purchases they've made. 0.
Wow.
Yeah. When the people looking at the internal balance sheet are taking significant chips off the table, that speaks volumes.
It really does.
Mm-hmm.
And it forces us to look at the external pressures they are facing, too. Because they are bleeding cash internally to keep the lights on, but they don't operate in a vacuum.
Right. They're competitors.
The sources explicitly introduce a rival, IonQ. And the consensus there is that IonQ maintains a clear, widening lead.
In what way?
We're talking about better commercial traction, faster revenue growth, and superior platform integration.
I want to focus on that phrase for a second, platform integration. Because looking at Rigetti's revenue, it seems heavily reliant on government funding cycles and selling very specific hardware, like their Novera QPUs.
Right.
But first of all, let's clarify what a QPU even is for anyone who isn't, a quantum physicist.
Sure. So a QPU is a quantum processing unit.
Okay,
You can think of it as the quantum equivalent of the CPU inside your laptop.
got it.
But instead of processing information in simple binary bits, ones and zeros, it uses qubits, which can exist in multiple states at once, thanks to quantum mechanics.
Mind-bending stuff.
Very. It is the physical brain of the quantum computer, and manufacturing them is incredibly difficult.
So Rigetti is selling these physical QPUs primarily to government-backed entities.
Yes.
Contrast that with IonQ, which is leading in platform integration. It sounds like IonQ is building software and cloud ecosystems that businesses can actually use today.
Exactly.
While Rigetti is sort of stuck acting as a highly niche hardware contractor for the government. So where is Rigetti's competitive moat?
Well, what the data reveals is that there is absolutely no evidence of a durable competitive moat for Rigetti right now.
None at all.
None. A moat is a distinct advantage that protects your profits from competitors, like a powerful brand, immense scale, or a software ecosystem that customers can't easily leave.
Like what IonQ is doing.
Right? IonQ is building that ecosystem.
Yeah.
Rigetti's relying almost entirely on government timing, which introduces massive execution risk.
Because you are essentially chaining your high-tech roadmap to the speed of political bureaucracy.
Which is never fast.
No. If a federal budget gets delayed or a specific grant program is restructured, a normal commercial enterprise might just see a dip in profits.
Sure.
But for Rigetti, given that shrinking $27 million cash pile, a delay of a few months could be an existential threat.
It really could.
Oh.
So we have laid out a very grim fundamental picture here.
Extremely grim.
Massive operating losses, a ticking cash clock, the threat of a dilution doom loop, insider selling, and a competitor pulling ahead in commercial integration.
Right.
But the stock market is looking at all of these red flags and reacting in a deeply contradictory way.
Let's look at the technical realities of the stock right now, actually. As of August 14th, 2026, the stock closed at $18.82.
Okay.
It is down 67.6% from its 52-week high of $58.15.
So a huge drop.
Right. It took a massive beating over the last year, but it is up 50% from its 52-week low. It's showing this bizarre mixed momentum. It is trading above its 20-day and 50-day moving averages, but below its 200-day.
So it's oscillating wildly.
Exactly, seemingly unable to decide if the company is dying or recovering.
That technical confusion in the stock chart is perfectly mirrored by the analysts covering the company.
Totally.
You have the Q2 revenue missing estimates, the stock dropping 3.8% in after-hours trading, the surging dilution risk.
And despite all of that mathematical reality, analysts from Wedbush and Benchmark recently initiated coverage on Rigetti with buy or outperform readings.
Which sounds crazy.
It does. They didn't just suggest the stock might stabilize, they set massive price targets.
Oh, massive.
Wedbush set a target of $40. Benchmark said $25. The stock is sitting at $18.
Right.
So how can a financial analyst look at a company with $27 million in cash, burning $30 million every half year, and model a scenario where the value more than doubles?
Well, it goes back to how you value expected outcomes in deep tech.
Yep.
These bullish analysts are looking at what we call upside optionality.
Upside optionality, yeah.
They are not valuing the company as it exists today. They are pricing in a probability.
I see.
They are arguing that being down 67% from the high means all the bad news, the cash burn, the lack of a current moat, is already priced into the $18 stock.
It's rock bottom in their eyes.
Right. If Rigetti solves a key technical hurdle tomorrow or secures a massive influx of non-dilutive capital, the commercial floodgates open.
So they are betting entirely on survival. If the company simply survives the next year, the upside is astronomical.
But if you're an investor, you have to weigh that astronomical upside against a very real mathematical chance of going to zero.
Which is terrifying.
It is. The market as a whole is leaning cautious. The net sentiment is definitely bearish to neutral. But those few loud bullish voices from major firms like Wedbush are keeping the momentum alive.
They are modeling a future where the cash crisis is magically solved.
Essentially, yeah.
But hope is not a strategy. To hit a $40 price target, something concrete has to happen to save that balance sheet.
Absolutely.
What are these analysts actually looking at on the horizon?
This is where the upcoming event calendar becomes the most critical piece of the puzzle.
Okay.
There is one massive wild card that could change the entire conversation overnight. The CHIP PS Act.
Oh, yes. The sources reveal a detail that initially blew my mind. On May 21st, 2026, a $100 million CHIP PS funding letter of intent was signed for Rigetti.
$100 million.
$100 million. That instantly wipes out their cash runway problem and gives them years to develop their tech without diluting shareholders.
But you have to read the fine print on a government announcement like that.
Always fine print.
Always. A letter of intent is exactly that intent. It is absolutely not cash in the bank.
Right.
It is an agreement to move toward funding, but it's subject to grueling due diligence, technical milestones, and final bureaucratic approvals.
So the timing is up in the air.
Completely uncertain.
It's like getting pre-approved for a mortgage, but you haven't found a house, the seller hasn't agreed, and the bank could still pull the plug if they don't like your inspection.
That's a great way to look at it. And when your cash runway is shrinking by millions every single month, playing a waiting game with federal funding is terrifying.
I can imagine.
The sources explicitly state that the timing of this capital is speculative. If the government paperwork takes 18 months, Rigetti doesn't have 18 months of cash to wait for it.
But they do have another iron in the fire that has a hard start date. There's the Tango Lab partnership.
Right.
This is a National Science Foundation-funded project partnering Rigetti with Hewlett-Packard Enterprise and the Pittsburgh Supercomputing Center. That officially kicks off on September 1st, 2026.
So if we tie those two catalysts back to the cash burn problem, the path forward becomes very clear, but incredibly narrow.
Okay, lay it out.
If that CKGS Act money actually lands in their bank account, and if the Tango Lab partnership quickly yields tangible product milestones that they can commercialize,
Then the cash crunch is solved.
the cash crunch is solved, the dilution stops, and those $40 price targets from Wedbush suddenly look very prophetic.
But if they hit a wall,
If the government paperwork stalls in committee and Tango Lab turns out to be just another slow-burn R&D project with no immediate commercial application, Rigetti is trapped.
they'll need more cash.
They will have to issue millions of new shares just to survive the winter. The dilution doom loop kicks into high gear, the share price tanks, and competitors like IonQ will absorb whatever market share is left.
It is a completely binary outcome.
Totally binary.
There's no middle ground where they just muddle along for the next 5 years. They either secure the bag and achieve a massive breakthrough, or they burn out.
So, synthesizing everything from the financial reports to the market sentiment, the sources ultimately land on an overall rating of 4 for the stock,
Okay, which means
which translates to a firm neutral stance. Rigetti is offering high growth upside optionality, largely driven by that potential government funding, but it is chained to extreme cash burn and execution risk.
it is a classic high-risk wait-and-see scenario. The research horizon suggested by the analysts is 6 to 12 months.
That's the window.
That is the critical window where this will be decided. It hinges almost entirely on whether that HTS Act money arrives before the corporate checking account hits zero.
Which brings up a much larger issue for you to consider.
Oh,
We spent all this time analyzing balance sheets and domestic competition, but quantum computing is a global arms race.
definitely.
The technology is so powerful, it is literally a matter of national security.
It's not just about building a better software app, it's about defining the next century of technological dominance.
Exactly. So here is the thought I want you to leave with. If promising U.S. quantum companies like Rigetti are forced to slow down their research and development, constantly looking over their shoulder at a shrinking bank account while they wait for bureaucratic funding to clear, what does that mean for the global tech race?
That's a great question.
While Rigetti waits on CPS Act paperwork just to survive, is a heavily state-funded lab halfway across the world silently achieving quantum supremacy.
Wow.
Are domestic financial mechanics actually stifling the innovation we are trying to protect?
That is a chilling thought, and it really puts the entire concept of deep tech investment into perspective. Well, thank you for joining us on this deep dive.
It was a fascinating one.
Definitely. Keep questioning the numbers behind the headlines, and we will catch you next time.